Good afternoon, and welcome to our latest interview in the series Research That Matters. I'm Kinley Lamb, a Parker Scholar in the Parker College of Business, majoring in Finance and Business Management. Today, I'm here with Dr. Rongrong Zhang as she tells us an overview of her research and how it applies to daily business. Thank you for your time today, Dr. Zhang.
Thank you for the opportunity.
Can you briefly summarize your research project and its conclusion?
Well, my research looks at how the stock price informativeness affects the firms and trade credit decisions. So let me first give you some definitions about those two things. First, talking about stock price informativeness. The scholarly definition is how much private information is contained in stock prices. So if the stock price contains a lot of private information about the firm, then we consider the stock price is quite informative. So as we know, with the recent coverage of the GameStop, it seems like, everybody is paying attention to stock market, and even the amateur investor becomes quite knowledgeable about how to invest their money. So that's not exactly how we measure price informativeness, formally. So what we do is we take the individual stocks returns and use the regression methodology to look at how much the individual stock price variation is explained by the market return as well as the industry's return. So if we have a stock, let's say General Motors, if its stock price is varying over time and most of the variation is captured by the market index return and the industry return, then there is not much unexplained portion that's not understandable. So that stock is not informative. On the other hand, if with the stock price, a lot of variation is not explained by the market and the industry, then we think the stock has a lot of private information. And we can show the private information containing stock price allows us to learn and get new information and use that to guide our decision-making process. So my research looks at the stock price informativeness, how it affects the trade credit decision. So by trade credit, we mean suppliers, when they sell products to their customers, a lot of times they don't demand cash on delivery. They allow the customer to pay back later. So that creates a short-term financing to the customer, and that creates a short-term claim from the supplier. And we are looking at, in my research, I'm looking at whether the stock price informativeness affects the manager's decision on the trade credit. So my main findings are twofold. First, I found when the manager learns from the stock prices and expect better future growth opportunity, they tend to increase the amount of trade credit. So the second finding is this positive effect of price informativeness on the trade credit decision actually vary across firms. So specifically, I'm looking at suppliers that make relationship-specific investments versus those that don't make relationship-specific investment.
Okay.
So the relationship-specific investment, that's kind of a jargon. So I'll give you a simple explanation. When you have the supplier-customer relationship, a lot of times suppliers have to make some capital investment in order to make the products meeting the needs of their customers. So if they lose the customer, they may not be able to recoup their investments. So we consider that sort of investment relationship specific. And I found in my research, the suppliers with more relationship specific investments actually make less positive adjustments in their trade credit. And the reason, my hypothesis, and I show some evidence suggesting that the relationship-specific investments will make the supplier prioritize their cash holding decision over their trade credit decision. So those are the main conclusions of my research.
So you obviously seem very passionate about this. How did you become interested in this topic?
Well, I have done some research in the supply-customer relationship back in 2009. At that time, I had a joint work with one professor from Georgia Institute of Technology and Dr. Singer, and the other is a professor from Wilfrid Laurier University in Canada, Dr. Hendricks. So those two professors are experts in the operations management. They study how the supply chain network, specifically how the disruption in the supply chain network affects the shareholder returns. So we had a project back in 2009 looking at how financial diversification and the resource slack in the firm affects the stock return or the stock market reaction when we have a supply chain disruption. So we do find some evidence suggesting that when firms are diversifying their business, there are some positive benefits.
Okay.
And so that got me interested in the supply chain relationship. And the trade credit is basically a primary tool used by suppliers to foster a very strong bond with their customers. So that was over 10 years ago, and that paper was published in the top Fortune FT 50 journals. So in more recent years, I have continued my work in the area of supply chain relationship. Most recently, in 2020, I published a paper looking at how the stock market is valuing the cash holding of a corporation versus their trade credit. So what I found was firms or the stock market assigned a higher value, about 89 cents per dollar of cash holding that's assigned by the stock market versus about 39 cents per dollar of accounts receivable, which is the trade credit from the supplier side. So that means the cash holding is more valuable. So going back to my explanation for to your first question, when suppliers, when they have more relationship-specific investments and they prioritize their cash holding over trade credit, and that results in the more negative effect of the stock price informativeness on their adjustments in trade credit. So that's kind of my main conclusion.
Okay.
From that finding.
I know that we've kind of gone over this a little bit, but what do you think overall this means for business, and how can people in the business community use this themselves and use your research to apply to them in what they're trying to do?
Right. So scholars, we spend thousands of hours to develop an idea and then find related scholarly work and collect the data and then develop the methodology. In the end, we want our research being acknowledged by either being accepted by academic journal, but more importantly, we like to have our results known to the business community, especially if our findings are giving them useful information to help them make better decisions. So I think my current research, this project, is quite timely, also quite informative in two ways. First, the trade credit decision is a decision commonly used by most of the firms, irrespective of the size, both large and small or medium-sized firms. They tend to offer trade credit to their customers, and at the same time, they also receive trade credit from their upstream firms. So the trade credit decision is a decision, a daily or weekly decision you have to make. And what I found from this research suggests that managers can learn by observing stock prices and use that information to guide their trade credit decision. In addition, I don't talk extensively in my research, but I do mention there are some things managers can do to influence the price informativeness, which means that will create a feedback loop. If you want to increase or decrease your price informativeness, that will in turn affect your future decision making. So I think by learning from my research, I think it will help the manager to make more informative decision in the future.
Yes, thank you. So how are you able to bring your research about this topic into the classroom?
Well, I certainly welcome more opportunity in the future to talk about my scholarly work. But last week, when I was teaching my upper level finance class in the financial markets and institution class, I talked about the recent rise and fall of GameStop and some other stocks, and trying to explain to the students what's happening, and does that mean the amateur investors are more knowledgeable than those professional investors like hedge fund. So that's kind of like a classic David and Goliath story. And I think students are very interested in such stories, and it also encourages students to learn more about how the financial market works. And in terms of the scholarly side, I think it might be beneficial to help students to think there is like a spillover effect. So what happens in the stock market could actually influence managerial decision. And trade credit is certainly a policy that affects both the firm's top line and the bottom line.
Thank you. So what are some new challenges or unanswered questions raised by this research that can still be explored?
Well, I think, since the onset of the COVID crisis, we have a lot of free time, so we work from home, and it seems like, playing stock market becomes a national pastime. And I think this is a prime opportunity for scholars to look at what's the implication for future, not only the investment decision, but also the product market decisions. So what I mean by that is, on the one hand, stock market is the place a lot of different types of investor and trader congregates, and we have both informed traders and uninformed traders, which means we have heterogeneous belief about a price of an individual stock. And this price discovery process is very efficient, and it also helps managers to make better decisions. But with the rise of the amateur investors, what we want to know is, does the increased participation of the amateur investor increase the price informativeness or the price discovery process, or making it less efficient and creates or introduce more noise to this price discovery process? So I think that's one question that's yet to be answered. Secondly, I think also the regulators have to figure out if they need to make changes to the current rules and regulations with the significant participation of those amateur investors. So I think there are plenty of opportunities to conduct research in those areas.
Great. So I know you said that you've been working on this research for a while. Are there any, new or exciting breakthroughs that you think could be happening within the near future that you would be excited to share about?
Are you talking about this specific project? Well, I think if I could extend the research by using more recent data, it may shed light on how the changing landscape of the stock market, especially the price discovery process, is going to affect the finding. So the current finding is based on the data up to 2018, which is before the pandemic. So I would like to learn more about what happened, the recent development in the financial market, how that affects the results.
Thanks, Dr. Zhang, for sharing your expertise with us.
Thank you.
I hope you enjoyed learning more about Dr. Zhang's research.